Welcome. Today, we are taking a huge leap into one of the most financially dense regulatory battles in India. If, as many elders of India's banking claim, that the total assets under management within the pension funds for India's PSBs was valued at Rs 4.28 lakh crore or 42.8 billion US dollars, why is the government and some courts pleading unaffordability? I am Priyank Chakraborty and my co-host is Anil Agrawal.
Great question, Priya. Especially so since many retirees insist this substantial corpus is sufficient to secure pension updation for millions of bank employees and retirees without the government contributing 1 rupee.
We're talking about the complex world of the Indian PSB's pension system, not least actuarial evidence that the corpus is large enough to fund updation. And yet, the government and many courts in the land have shirked away from upholding the constitution in favor of retirees.
Apart from the corpus, there's a human story to be told, dating back to Mr. M.C. Singla in 2008, who along with thousands of other retirees are long deceased. The elders who served the banking sectors diligently are literally buried under years of government policy inaction, legal maneuvering, and regulatory standoff.
So, to set the stage for you, what kind of scale are we talking about here?
The scale is astonishing. We are talking about a defined benefit or DB corpus that's grown to an incredible size, nearly 50 billion US dollars or 5 lakh crore. It is humongous.
To put this in its proper context for you, the listener, the corpus is about 1.21% of India's GDP, estimated at 4.13 trillion US dollars in 2025. And it's all held in statutory trusts.
That number alone should grab your attention. It's a huge financial engine, and our mission today is to cut through years of highly charged rhetoric and misinformation.
Exactly. We're going to provide verifiable arguments in 4 critical areas. 1. The core demand for pension updation. 2. The true financial mechanics of that massive fund. 3. How rigid accounting standards are forcing this conflict. And finally, 4. Which regulatory shifts might be pointing to a solution.
And we really have to start with the core of the conflict.
Absolutely, because once you understand the simple injustice of inflation meeting frozen retirees' pension, I think the rest of the debate just makes immediate sense.
Right. Let's unpack that fundamental problem. So, when a bank employee retires, their basic pension is a defined benefit.
Okay, it's calculated based on the average salary from their final 10 months of service, but the critical part is that calculation is permanently frozen. It never ever changes.
And that's the fault line. That's the whole problem right there. Yes, pensioners get dearness relief or DR based on the consumer price index, which is meant to compensate for inflation.
Exactly, it's adjusted semi-annually, but here's the key difference, and it's a big one. DR only maintains the purchasing power of that original frozen basic pension. It doesn't rebase to later years, it to match the vastly higher pay scales that current employees get, the ones negotiated in the bipartite settlements every few years.
Precisely. So if a person retired 20 years ago and a new recruit today earns many times what that retiree's final pay was, the gap just gets wider and wider year after year.
So the retiree keeps their original purchasing power more or less, but they lose all relative economic parity with the very sector they helped build.
That's it. That erosion of relative standing is what drives this demand for updation. The retirees are just seeking a method to update their basic pension so it keeps pace.
And the model they're pointing to isn't some fantasy, it's already in use. They point directly to the Reserve Bank of India, which has a functioning system for this.
And they have legal backing for this claim. They cite the formula used by the RBI and they back this up with judicial history, specifically a Supreme Court order from 2012, which set a strong precedent.
And what is that formula roughly?
The preferred mechanism is the RBI Updation Formula. You take the basic pension, add the dearness relief, and then add 10% of that total. It's not a massive handout. It's a mechanism to restore that lost economic balance.
But this is where it gets bogged down in legal arguments, right? Specifically around one regulation.
Regulation 35 Chapter 1 of the Bank Employees Pension Regulations, 1995, which underwent a critical amendment back in 2003.
They replaced the weaker word will with the unambiguous commanding term shall be updated.
Yes,
So it went from a suggestion to an order.
that's the entire legal foundation for bank retirees' argument. When a legal text uses the word shall, it's not a suggestion. It's a statutory obligation. The principle is clear. If a statute is unambiguous, courts are supposed to give it effect immediately, regardless of the financial consequences.
That seems like an open and shut case then. If the statute says it shall be updated, why are we even having this conversation? Why hasn't a court just enforced it?
While the language is legally strong, the banks and the Indian Banks Association, the IBA, have always argued that immediate implementation would trigger a massive unacceptable liability shock on their balance sheets.
It would threaten their capital adequacy ratio.
Exactly. So the courts, while they're sympathetic to the legal standing of the retirees, are also trying to navigate the systemic risk to the whole financial sector. The question shifts from, is it legally right, to how can this possibly be implemented without destabilizing the banks?
The 4.28 lakh crore rupees or $42.8 billion corpus has fueled what the pension fund surplus myth.
This myth is extremely damaging because it completely misrepresents the financial reality. We have to be clear that 4.28 lakh crore is not a savings account. It's a corpus held in statutory irrevocable trusts protected by the Income Tax Act, and it's meant only to satisfy the promises of a defined benefit scheme.
So help me understand this. Why can't we just call a fund with that much money a surplus? Why is that mathematically wrong for a defined benefit plan?
Think of it this way. These pensions are calculated not as cash in a vault, but as an enormous long-term annuity obligation. It's like trying to calculate the total cost of a 60-year mortgage for a huge skyscraper complex, but you have to calculate it all today.
I see. So the liabilities stretch out for decades, possibly until around the year 2068. They cover every employee who opted in, even those still working, who will eventually need their pension.
To calculate this debt, banks use actuarial valuation, usually the projected unit credit method, with mortality tables from LIC. It calculates the present value of all future payouts.
So having a big balance now just means your current annual outgoing payments are smaller than the astronomical debt you've promised for the future. Equally, if the present value of your future liabilities is more than your current assets, you have a shortfall, not a surplus.
That simplifies the complexity brilliantly. The money is accounted for. It's just waiting for liabilities that haven't matured yet.
Okay, address the integrity of these funds. A few years ago, there were these big public outcries about so-called diversions from PNB and OBC. What was the real story there?
The perception was definitely one of malfeasance, but the Government of India clarified that no misappropriation actually happened. The issue was purely technical.
It was related to accounting standards, specifically AS 15 and AS 19. For example, PNB had a reported write-back of over 2,000 crores. This wasn't returned cash. It was a corrective accounting entry.
Can you explain that accounting mechanism? Why would an accounting standard force a bank to suddenly credit back interest?
It's a crucial detail, as 15 dictates how banks must value the assets in the pension fund trusts. For a while, some banks had failed to properly account for the interest accrued on investments as part of the total fair value of the plan assets.
So they weren't counting the interest the investments were making.
Exactly. When the accounting standard was strictly enforced, it forced them to fix their books and recognize that accrued interest. This led to a big one-time credit or write-back.
Fascinating. So if the funds are structurally sound in the long run and the statutory obligation is clear, let's go back to that regulatory brick wall. What is the precise financial barrier that's stopping the IBA from just saying yes to updation?
The issue remains the initial balance sheet shock. For prospective updation, and this means no demand for back pay or arrears, the estimated total actuarial liability that must be immediately booked is around 80,000 crore rupees.
And under current rigid accounting rules, the banks have to provision that massive sum instantly, which creates an immediate catastrophic hit to their books and their capital adequacy ratios.
Wait a minute. If they're worried about booking 80,000 crore, but we know the scheme runs until maybe 2068, what's the real annual cost of running the updated pension?
This is where the numbers get truly shocking. The same actuarial documents show that if this 80,000 crore liability is smoothly amortized or spread out over the remaining life of the scheme, say 46 years, the actual annual operational cost averages out to a highly manageable sector cost of roughly 1,740 crore.
So the problem isn't the cost, the problem is the accounting time frame.
You've hit the nail on the head. The PSPs are financially capable of absorbing 1,740 crore a year, but they are terrified of the mandate to absorb 80,000 crore in a single quarter. It's an accounting bottleneck, not a solvency issue.
The solution being pushed to bridge this massive gap is called regulatory forbearance for amortization.
The recommendation to the RBI and the Ministry of Finance is to grant special permission, a kind of regulatory waiver that allows the PSBs to spread out that 80,000 crore shortfall over a defined period, say 5 to 10 years.
And that one action would solve the immediate problem. It immediately mitigates the acute balance sheet impact, preserves capital ratios, and allows them to phase in the statutory obligation.
And this push is happening while the government itself is setting a major precedent with other pension systems. Let's talk about the new Unified Pension Scheme, or UPS, for central government employees.
The UPS is an optional scheme under the NPS framework, and it's really relevant here because it explicitly offers a guaranteed defined benefit component.
A guaranteed payout of 50% of the 12 monthly average basic pay, with a minimum of 10,000 rupees a month.
So the government is saying that even within a modern funded system like NPS, they are willing to provide a guaranteed index-linked benefit.
Absolutely. And this fundamentally strengthens the PSB retirees' argument. If the central government is actively creating a defined benefit guarantee in a new system, how can they resist updating an existing defined benefit system for PSBs?
Other major points of contention remain. For example, those that directly impact pension calculation and quality of life for retirees.
Let's start with the special allowance dispute. This mostly affects those who retired after November 1st, 2012.
The issue here is the special allowance, or SP, a universal payment to serving employees. But historically, banks have excluded it from the definition of pay when they calculate things like pension and gratuity.
So the logic is, if you get this allowance every single month without fail, it should be counted as part of your pay for retirement calculations. Retirees say excluding SP just artificially suppresses their pension calculation.
Then there's a big disparity in inflation compensation based purely on when you retired, the DA neutralization issue.
This is a really intense point of division. Retirees who left before November 2002 do not receive 100% neutralization in their dearness relief, but those who retired from December 2002 onwards do.
And this arbitrary cutoff means the oldest retirees, the super elders of India's banking, the ones least able to handle financial strain, face a much bigger financial loss from inflation compared to their peers.
It's an artificial classification, basically penalizing those who contributed the longest and retired the earliest.
And finally, health insurance. Premiums are a huge burden for retirees.
The long-term goal for retirees is to get the banks to bear the full premium cost, just like they do for serving employees.
So right now, the most immediate fight is to secure a GST exemption on the annual premium for their group medical insurance policies.
This deep dive has made it crystal clear. The main barriers for updation are purely administrative that can be corrected at by government policies. The other issues stem from a rigid short-term accounting mandate that creates a huge single-year liability shock, thus obscuring the manageable long-term cost.
The solution requires one primary regulatory action allowing amortization and the political will to enforce Regulation 35 form.
And if we connect this back to systemic risk, we have to consider the incredible leverage the banks currently have.
However, by rejecting a negotiated offer of prospective-only payment, the government pushes the entire dispute back to the courts and runs the risk of judicial mandate to make retrospective payments. The continued impasse risks turning a manageable accounting problem into a catastrophic legal and financial defeat.
Thank you for watching. Please share with friends and family, like and subscribe. Until the next time.